Okay, so we're on live.
Is the gentleman coming on? The lender?
Yes. Where is it? Text him now.
You want him to go first?
He has asked. It's we're on live.
Oh, okay.
Okay. um. Oh wait, one sec. Where is? Wait, I stopped it for a second so I could say what we're doing. All right, so I finally mastered this Facebook and Zoom stream.
Good job.
Finally, it took some time to get it together because it was like taking me through all of these things, and it just didn't want me to be great, but we were gonna we got it together. Okay, so Paul is coming in.
Am I in? Am I in?
Hi,
You're
Paul.
in.
Hey, hey.
Hey, good afternoon, Paul. Paul, that's Corinne.
Hey, Corinne. I'm
Nice
still
to
in the
meet you.
daggone.
You're still in the office? I see.
Shouldn't be.
Me too, technically, but I work from home.
Oh, yeah. I
Right.
didn't want
I'm still in the office too, pretty much. The non-existent office.
to. I actually went to my Greenbelt office. Uh, I just want to get out of the
Okay.
house
You
for a
want to get
minute.
out?
Yeah, nobody's really in here. One other person, and he's in his office.
Okay.
The door's shut.
Got you. Got you. Okay. Well, we got like another minute and then we'll get started. And we're streaming live on Facebook as well, Paul, just so you're aware.
Oh, let me turn my phone off.
Yeah, I'm doing the same.
Yeah.
We'll
It'll
turn it
start buzzing and beeping and ringing.
down. Being annoying. Let's see.
As soon as I go to turn it off, someone calls. So perfect timing.
Right. Okay, so let me make sure. It says we're streaming, but I don't see it on my phone, so that's why I'm just making sure.
Yeah, I was trying to find it too. I see it says live, but I should be able to see it over here.
Corinne, are you to fix my credit?
Yeah.
Ah, I could use
Okay,
you.
I see it. I see it. It's there.
It's
It's
on your
just
real estate page.
on my regular my personal page.
Oh, okay.
I did see it on the personal page. So
Oh, that's why I can't find it.
yeah. Oh yeah, I put it on that page because so
Got
that
more people over there.
right, more people that are on the personal page. So
There we are.
oh yeah. Sit on that page because
I'm gonna turn it down so we
yeah.
can't hear it.
Okay, well, we are going to get started. Today, we are going to talk about one first, which is one of the biggest obstacles that people normally have to purchasing a home, besides money, is the reason is their credit. And so I've learned that a lot of my clients that aren't ready at right now, they need to get prepared to be ready. Sometimes it's easy to do things as far as their credit is concerned, easy fixes, and sometimes they need a little more assistance to understanding credit and how it works and what to do. So I wanted Corinne to talk about that aspect of the home buying process and the steps to take. And it's okay to need to take steps. It's just that you want to make sure you're taking the correct steps. So that's where you come in. Paul, after you get people together that aren't sometimes quite ready, then Paul is able to help them with actually purchasing the house. And because sometimes people go to him first and then they're not quite ready and then they have to go to you. Some people know that they're not quite ready and they come to you first. So it back up, it depends on the person. So I just wanted to make sure that people have an understanding of what they need to do from your side, and then as well get an idea of how things are running in the market, the current COVID market and purchasing a home. And I'll talk a little bit about that from the real estate side, and Paul can talk about it from the rates and refinancing and things of that nature. So I will hand it over to Corinne first, ladies first.
I feel privileged. First, I wanted to start off just by saying I absolutely love my job. This is a godsend to be able to, support people and talk to them about credit. Ooh, I got bigger. My biggest advice, I'm going to give it up front for credit, is just to get started. Don't be afraid. I have so many clients that come and they don't want to know. They're all just like, no, it's terrible. It's terrible credit. I look at hundreds of thousands of people's credit. So I know terrible when I see it. And most of the time it's not that bad, and we can recover it in 3 to 5 months. So that's just the start. It doesn't have to take years to get it done necessarily. There are a lot of factors that are very impactful to your credit. The first is going to be, let me just lay the groundwork, because one of the biggest questions I get is about credit karma. So, Credit Karma, Credit Wise, Credit Sesame, Identity IQ, and why are all those scores so different? And why does that thing say I have a 700 and then I go see Paul and he say I got a 12,
Pretty much.
I'm exaggerating, but in general, here's a little scenario. So if you are getting a credit card, and the amount of the credit card is between $300 and $10,000. So that's a certain level of risk. And so, the amount of money that you're trying to pay back, it may not be that big of a risk for that that creditor. So they're going to give you a formula for that. And then you go and you try to get a car, and that car is from $10,000 to $50,000. So a little bit more risk, got a lot more going on. They're going to weigh different things. They're going to go into some of those other formulas for that to see how worthy you are to pay, credit worthy you are to pay that back. Now, you want to buy a home somewhere between $100,000 and $1 million. I'm just going to throw that out there. We can't use the same factors. They can't use the same factors and the same measuring things and consider the same things as they would for that $300 card. It just doesn't make sense. And that's why you have these different scores. Another factor about that is that Credit Karma and the like are using a proprietary thing called a Vantage score. And Vantage scores were designed such that all of the lenders and the other people would just get inspired and jump over to their model and use it. And that did not happen. So since that didn't happen, they kept up their way of doing things, but all of these industries didn't buy into that. And so you got these different scores. My personal experience is I have a 733 on Credit Karma. I had a 755. I paid some things off. We're not going to talk about that. And then my scores went down. And I'm refinancing right now, and they're using a 690. So if you have to stay committed to trying to use something like a Credit Karma. Just use it to make sure you're going up in the right direction. But don't go to Paul and say, but Credit Karma said, because that is not going to be fun for your experience at all. And at the end of the day, what he's going to pull for you is the gospel, because that's what they have to use. It can't use anything else. All right, so let's get into it. So a couple of factors. First is going to be your payment history. It's really strong. It's the strongest factor. It's paying your bills on time. And I always get folks that are so concerned about inquiries. Don't inquire, don't pull my credit. They don't want the lender to pull the credit. Nobody. It's like, first of all, lender's got to pull your credit. And you're talking 3, 5, 15 points for an inquiry, but you're talking 175 points, 50 points that you could lose for having one late payment. Okay, so let's weigh that out. All right, so if you have charge-offs, collections, anything like that, late payments, 30 days, 60, 90, that's going to affect that 35% negatively from a credit perspective, but also from a lending perspective. Certain loans, if you've had late payments recently, might also create a problem for yourself as well. You take that up with Paul. So definitely want to keep things on time. And my tool is I put them on auto pay. And that's very helpful because I did the program too. I'm a law-abiding credit citizen. Your next factor is going to be 30% will be your utilization. So if you can just get these two together, you're cooking with gas. So now we're up to 65%, 30% for the utilization. So you want to keep your cards down to 10%. I know somebody told you 30 was amazing, but our suggestion here, we're aggressive and we're trying to be strategic, is no more than 10%. So if that's $1,000 card, you're going to be right around $100, and then not to pay it off completely, leave at least 1% on it. Now, we've added a little, I'm going to tell my COVID advice, is we've added a little boost to that by saying, once you get between the 1% and 2%, the sweet spot between these two numbers is 2%. Okay, so if you can get it down to 2% during the home buying process, that might give you a little boost on your credit, even more so, because a lot of the score requirements in lending are more stringent nowadays. So you might need a little extra boost in your credit. Now, I said all that, great credit conversation, but I love to provide the balance between credit and lending. I'm not giving you a check. So you need to check with Mr. Paul, because he may say, forget what Corinne said, you need to have some capital because you got to close on this house. All your credit cards be down to 2% and you can't buy the house, nobody cares, okay? So you gotta have the balance between my great, amazing credit advice and what your lender needs for you to do capital-wise in terms of coming to the table with some dough, basically, okay? Gotta have some balance in that. And then also, I'm a budget girl. I support people with budgets as well. You need a stash. You really do. So you don't want to go ham on credit and don't have any liquid assets to touch. In any case, house buying or not, but that's what we're here for. Next 15% is length of history. Don't ever close your cards, period, next. You want your cards to be super old. Your cards need to be old. You know, I always parallel them to children. We love cute little children, but they need to grow up and start talking and walking and going to college and leaving home, okay? So you want your credit to do that, and you want your credit to be mature and not keep starting over all the time. My father's credit is 34 years old. I don't know what I was thinking, because I'm 48. I should have some 30-something-year-old credit too, but I don't, because I didn't know better. I closed stuff, paid it off, and closed it. So keep them open. That's going to make it easier for them to see that you can handle credit well. Your credit report is a book. It's telling a story, and you want that story to say, I have been doing this for a while, I'm good at it, okay? Your inquiries. Now I'm gonna give you some life advice, and then I'm gonna give you some home buying advice. Your life advice is keep your inquiries spread out. No more than 6 in a 6-month period. They stay on your report for 2 years. My home buying and credit building advice is don't apply for nothing. You don't need no new stuff, no new cars, no new, none of that stuff. Talk to your lender first, check it out with your credit person. I get people calling me saying, hey, the ones that follow the rules, can I apply for a phone? It sounds childish, but I'm glad they called just with the mindset of checking it first before they start getting unnecessary inquiries for things or unnecessary liabilities before they get to Paul. And my daughter was applying for a home, but her DTI is not where it needs to be because she just bought a car. And she wasn't trying to buy a house. Of course, I would have advised her not to, but that's what threw off her DTI. And lastly is going to be a mix of credit. In that storybook that you're telling, you want to have diversity. Say again, dear.
Sorry, can you say what DTI? Can you say what DTI is?
I said, you know, I said it in my head. I said, you said DTI and you didn't tell nobody what it was. Your debt to income ratio, which I'm sure Paul would talk about. But in my daughter's case, because she bought the car, the amount of income she had was not sufficient to make her ratio good for buying a home. Well, let me say that better. It qualified her for $55,000 as opposed to $110 if she didn't have the car, and $110 could have got her a little nice piece of something in San Antonio, Texas. So that car took a $60,000 chunk out of what she could qualify for her house because she bought it before she went to the loan people.
Makes a huge difference.
She's 24, and I just sent her to the realtor to start learning about this process, and she got a lot of aha moments out of realizing how that works, and so it was really powerful for her. She's like, oh, I didn't know that. That diversity in credit, when we're telling the story, they just want to see that you can handle different types of credit. I get all types of clients saying, I have a car, my credit is about to go through the roof. That's all they have on their credit. Not going to happen. You want to utilize those credit cards. We'll show you how to do it responsibly and spread it out, not 5 at a time. And a minimum of 2 major credit cards would look pretty good. At least 1 department store card, like a Home Depot or Ace Hardware or something. I say get ones that you don't like to shop at. Don't go get a Saks card, okay? Not a good idea.
Right.
And, I literally had a client where to support her, I put on my calendar, check with such and such to make sure she hadn't bought any pocketbooks. Because she's like, I'm gonna be honest with you, I got a sponsor with Coach. I can't not do it. And I said, okay, I'm gonna check with you on this every such and such in a month to make sure we're on track for this house. You put all those Coach bags in your new closet after we get you to where you need to be.
Right.
So those 3 things. What you say, dear?
I said she knows her vices.
Exactly. So that kind of diversity in credit with a little bit of credit cards, charge cards, and either a home loan, student loan, or car loan are going to create a nice big picture that you can handle and juggle different types of things. And what a beautiful pie story for saying that you can handle a whole home. Okay. What else I got? Off the pie. So now we know the factors. I'm just going to throw out a couple little budget things. And one of those would be that lots of folks come to me wanting to passionately pay off all of their collections. So they're so committed to that. And it's so cute. However, it's not always the biggest bang for your buck. Okay, here's why. So we're talking about a pie. You know, I explained my pie to you. And the first part we talked about was the 35% for your payment history. If you are cleaning up a collection, you are addressing only the mending of that 35%. So the other 65% is not affected by paying off that overriding bill. It no longer contributes to your length of file, no longer contributes to your utilization, no longer contributes to the diversity of your credit. You're only kind of cleaning up the payment history. Right?
Okay.
And your open card, I had a gentleman, this is all random, so I'm not saying anything about anybody, you know. And he wrote me a letter, he's in our program, and I already told him all this stuff, and he's very committed to saying, hey, I really want to pay this $153 on this collection, and I'm sure it's going to help improve my credit. And I'm like, no, dear heart, it's not. Specifically because you have a Navy Federal card for $5,000 and it has a $4,997 balance on it. So I need you to take that $153 and put it on that card first. Okay. So I'm in no way suggesting not to keep your words and commitments to your bills, but in terms of prioritizing your capital, it's going to have 90% effect on the rest of your credit, your length of history, your utilization, your diversity, and timely payments to address those open cards, vice you and keeping your loans on time and so forth, vice trying to clean up that collection. But here are the exceptions. all these rules. The exceptions to those that I have for you are student loans. So student loans in collection, you gotta go handle those, okay? And what the heck is that? Sorry, I forgot I had two phones. Turn up. Student loans, you gotta go handle those, and we have some places to send you in order to do that. And then I call it anywhere anybody's coming for your neck. So if it's getting ready to go to judgment or something like that, you definitely need to take care of that, those type of things. And the last would be, but this is also a space where you get to talk to Paul, your lender, apartment rent. So I have some lenders that advise us to advise clients that certain types of apartment debt needs to be addressed before they come back to them, because underwriters look at it like, you didn't pay your rent. Why would you pay your mortgage? So that I usually check in to see what that lender's programs say about that. But normally those three things are the things that I have to tell myself or my team to address in terms of collections. When I say don't prioritize them first, but those three right there, you need to take care of. You need to have a conversation or a dialogue about. Okay.
Okay.
So shorter questions. That's all I got right now. I mean, I got a whole brain full of stuff, but that's the good thing.
So what would be one of the ways that, okay, if I don't have any credit, what is a good way for me to start some type of credit?
I would start primarily with a department store card. If you're in the low 500s or so, potentially like maybe a Fingerhut card or something like that. Go find cards that say they're designed to help people build credit. Mm-hmm. I've been looking into Self just to see what I think about it. I'm not finished researching it enough to advise it, but there's like a self.com situation that helps people build credit. But you definitely want to stay, what I can say to stay away from is predatory things that you get the card and there's already $100 on it. I've seen that. As soon as you get this $300 card, it's got $100 that you need to pay already. It's got ridiculous interest rates and stuff like that. So you may need to, when you're in our program and we're supporting you with that, oftentimes we've had to help resolve some of the negative items so that you can even qualify for something. And that includes secured cards, because I've had people's secured cards be denied. So yeah, so a good, if you want to try, and then also you have to be careful with this as well, is you can start with, I literally just did this today. I added my daughter to my cards, my good credit cards. So I just did it like an hour ago, because she's 20, so I'm helping her build her credit. We're cleaning up the three things that are on there, and then that's a good start to help building that credit. But me personally, she's not getting any of those cards.
Right.
That's not how that works.
I advise that a lot to add as an authorized user. Yeah. I do that several times a week. Tell folks, just make sure that they have a good history and that monthly payment is low, because it adds to your debt to income. Yeah,
that's what I was going to ask you, because I think I just inquired about that with a lender 2 weeks ago, because they were telling me not to have them added on the things that are $200-$300, because that's part of your debt to income.
Yeah.
Now you want things you want people to follow the same thing as if it was yours. So low utilization, their late payments or your late payments, you want to make sure that's okay. And it's more advantageous to get one like their older card, so you can also have the benefit of that as well. But I have told several people, you need to come off that card, because it's at like 90% utilization and they're not keeping it on time. And if you don't have that relationship, I'll use myself. I've done super work on my credit since last year. Like I said, I'm up in the 700s, and I'm stalled a little bit because I don't have the time. So I'm getting ready to be added to my father's 34-year-old credit, so I can kind of see how that affects with that time. However, that's my best friend, and best friend said, I have a project that I did on this card, and so that has my utilization at higher than I think is beneficial to you. So let me pay that off first, and then I'll add you. If you're not dealing with a person who has the courtesy to say that, and they know you're buying a home and you become an authorized user, and they just went out because it's COVID and had to pay their car payment with it for 3 months, and now they're not going to say that to you, I wouldn't do it. I would want someone who's going to be communicative and supportive of your process that knows, hey, I need to say something. This is about to be late, and that's going to affect you.
Right.
Yeah.
And I have there's another question. So as far as like how old can like adding your children to your credit card, is there an age that they need to be in order for you to start establishing their credit?
Sure.
Because that's a thing, like most people, don't establish their children's credit until they've gotten out of school, out of college, and that people then start trying to build credit. Is there like a way that I have a credit card and, just like you're doing with your daughter, is there a certain age that you start building their credit history?
Oh, that makes me so excited. That is a great, fabulous question. In general, it's 16. However, I just did it an hour ago, like I said, and one of my cards said 13 and the other card said 18. Wow. So in general, it's around 16. You can start building credit for them, but I added I added her to Capital One and I added her to Amex, and I can't remember which one was which, but one of them said 18 and one of them said they had to be at least 13.
Wow.
Okay. That's helpful to know.
That's a great question. I wouldn't have thought about that.
And I recently did an Instagram live credit education seminar, and the young lady was sharing that her father put her on without her knowledge. So when she went to she's 26, and when she went to go get credit for the first time, she had a 720 and had never done anything. She was just on her dad's cards for all that time. And it was an amazing start for her. Really, I mean, she's 26, she owns a house now. She's a lender, she's doing great things, but she had a kind of a footing early on. He added her at 16. I think that I'm about to cry just thinking about it. It's so amazing.
Yeah, that's a special gift right there to start off with.
720. I started off with a 0, I think.
Yeah, keep all my Christmas presents. Yeah, just add me on that good credit. Unfortunately, I had a client who had no credit, but her parent put her on all her bills. The opposite scenario. She had electric and water and all kinds of things.
Yeah, I've seen that a lot.
I've seen that.
What a blessing to be on the other side where somebody put you on their positive stuff and gave you a footing, a nice head start.
Yeah.
All right. That was good, because I know some people, don't know that they could add their kids to their cards at an early age and get them prepared. Because I mean, what a gift to walk into a 720 out of nowhere when you had no.
That is a gift.
Yeah, that's
awesome.
A special gift. Because credit, when you're able to leverage it, it is, there's no limit to what you can do almost once you have good credit. So it's very important. So thank you.
One other thing I wanted to share, I forgot, is I always like to support people with how to find a good credit repair company, even if it's not ours. 3 very important things really quickly. So the first is going to be that they address all your negative items at one time. Okay, so you can ask them, like, how many negative items are you going to be sending letters for at one time? The goal is to get in the house as quickly as possible. So we don't want 18 months, a year, because you're dragging the submission of those letters out as long as possible to keep people, signed up for these things. Right? So if I had 33 negative items on my credit, our company addressed all of them at once. A percentage came off, and then we addressed the next round, the leftover percentage, and so on. Not 6 and then 6 and 6 over 40 days per cycle, which is how long the cycle is. The problem with that is Mr. Paul is addressing your middle score. So if the company that you're working with has this score up at a 700 and this one at a 600 and this one at a 580, because we ain't got to those yet, your middle score is still a 600. So it's not beneficial. You want those things addressed so they come up together, so that middle score has an opportunity to be up here with the rest of them. So that's number 1. Number 2 is this right here. I personally suggest visually seeing someone. Most credit repair companies work nationally, so they're usually not brick and mortar, but you should at least see a face. We do Zoom calls so you can see us, connect, and see who, that we're real people.
Right.
And I have several clients who haven't seen anybody and been paying someone. And then that one client I got, she didn't have any credit. So she paid someone for 9 months. And then when I went to run her credit, she didn't have credit. So I was someone working to improve her credit. When I went to pull it, she didn't have any credit. So after we finished crying and praying, we realized that, you need to have, get a referral or get, somebody who's actually got results and that type of thing. So that's important. And then the last thing is, I say don't pay a lot for that muffler. Credit is supposed to be in installments when they do credit repair. And so I had a client come as well who paid $900 up front, and you don't have any product, like you don't have any results, you don't have anything to pay that much. And then she had a little issue and she paid something late and her scores went down, and they aggressively were like, well, give us another 600. That's not how any of that works. That's not how you get to be treated. So, yeah, you should be iterative and you should make payments along the way so that you pay and then you check in with some results, and then you pay and you check in with some results, and you can also opt out at any time. So those are my pick a good credit repair company. Now, you pick one. It doesn't have to be us. I just want you to do well.
Right.
Yeah. Pick a good one.
Well, thank you so much, Corinne, for giving us that insight on everything. I have placed your contact information into Facebook for anybody who wants to reach out to you about getting started, because I know people credit is the thing that most people are embarrassed by. They don't want to talk about it publicly. They don't want to ask, I don't want anybody to know, that kind of thing. So it's a lot of shame and, people, and privately, hopefully someone, will reach out to you. So I put it in the comments so that people can connect with you and get started, because it's the only problem is to not fix it. That is a bigger problem. I know a lot of people who've had hiccups, including myself. I'm not immune to it as well. Everybody who has had it is just always just fixing the issue, addressing it and fixing it, because the longer you let it fester, the worse it gets. So that's the thing that you want to keep in mind. It's not it's okay to have had some problems.
Yeah, and no shame, just jump straight in. I had pre-foreclosures, I had repossessed cars. I was at a 5-something and I jumped in, and I was anxious about it and felt some kind of way, but I'm so glad I did it. And as dramatic as I was about it, it didn't take that long to fix while I was kind of mulling over doing it in the first place. So I'm glad I did it when I did it. And now I'm in the process of a refinance, and I'm in a position where when I couldn't do a forbearance, I actually can lower my expenses another way because I qualify for that refi. So just jumping the broom, so to speak, and getting started was the best thing I ever did. And if you name it, I had it on my credit, and I'm okay.
And look at you now.
And in this market, it's a good thing you didn't do that forbearance, because you wouldn't be able to do that refi.
Exactly.
Yeah. I mean, because that's a big thing in the market now is that they're offering forbearances, and if they're saying that it's not going on folks' credit. But a lot of folks are calling me and saying, I want to refi and have good credit. And some of them have even just called the lenders, the servicers, and inquired about a forbearance, haven't even agreed to it. And they're being told that they're not putting it on their credit reports. And they are showing up on folks' credit reports. At least they're telling me that I didn't even agree to it. And you cannot refinance when you're in that forbearance, and they're just putting out information about it. I mean, this is COVID, it's all new, it's a pandemic, so they're feeling their way through it.
Yeah, we just had that in our team meeting this morning. Somebody asked a question about that, because we have a client who they're 30 days late is showing up, even though they said they were doing late because of COVID. But you have to think that the algorithms, who has COVID algorithms, so who can push a button and say, please report that on your credit this fast, maybe later for COVID. So yeah, a lot of those things are showing up. how we're addressing it for credit is to encourage people to get letters if they actually do make those arrangements, so that we have something to fight with and when we're disputing. And it can be cleaned up in 1 or 2 days if they're not supposed to be. I'm not talking about the forbearance piece, because that still might have you not be able to do your job. But in general, if you're getting something delayed, a car payment or anything, get the letter, because if it comes erroneously on your report, we can get it corrected really quickly. But if you don't have any evidence but a phone call, then there's not a lot you can do with that.
Right. Absolutely. That's very good to know. And so with that, we'll go into Paul, and if you want to talk a little bit more on the forbearance, because that is, again, a big thing right now with a lot of people being out of work or limited hours and things of that nature. Like maybe the pros and cons of it, or, that kind of thing. If you could give a little more insight to people on that.
As far as the forbearance goes, I mean, the pros, truthfully, I think is just that it's there, and if you are in need, you can do it. All you have to do is call your servicer and say COVID, and they have to give it to you. You don't have to really go into a big explanation. You just have to tell them it's COVID related, and they will do it. I mean, I would say, just as Corinne said, make sure everything that you agree to is put in writing. If you don't need a full forbearance, like if you don't need for them to forgive your full payment, maybe you need a partial. Just make sure it's needed. Don't do it just because you're unsure. And unsurety is tough, but you're really kind of tying your hands more than it seems. We're realizing that, because I have a lot of people with really good credit, and they're like, oh, the rates are really good, and they are, and they're really in a great position to refinance and can't, because I pulled the credit and it says forbearance, and then I get emails back saying, well, they said that it wasn't going on my credit, and they said that I didn't even agree to it. I just called and inquired about it. So be very specific about what you want. I would be very specific about saying that I'm not agreeing to this. I wouldn't even call or inquire. You don't need it. Yeah. Right. I mean, it's really a need-based thing. And it's I believe because of the CARES Act that they have to do it. With government-backed loans, Fannie and Freddie. But if you have like what we call a portfolio loan with your specific lender, most of them probably are doing something, but they don't have to do anything. Portfolio loans mean they're in-house, their own specific mortgages that they make up themselves. Most lenders are doing something for you. But the state of the market is, I think Shawanda could attest to it, is thriving. We have a ton of clients, a ton of people who are trying to become pre-approved, ton of offers on these homes out here.
Yeah, very competitive, super competitive.
Yeah, you don't want to be caught after the pandemic. I keep calling it epidemic, pandemic.
Right.
You want to get pre-approved now. You don't want to wait. And I didn't say that from as we're trying to sell you something. I'm just telling you you'd be behind the 8 ball, because I'm terribly busy. So I know a lot of good lenders out here, and I know all of them are really, really super busy, pre-approving folks. So folks are out there really in the game, and you don't want to be behind the game. I mean, the rates are really good. I mean, yes, lending has changed because of COVID. I mean, guidelines have gotten stricter, but people are doing it, and we're sending people to Corinne. And I will start sending people to Corinne, because you need folks who can get results done. It's so many folks that you send them to someone to do credit, because I'm certified to do credit counseling, but I know what goes beyond my scope. I can tell you certain things to do, but when you have other woes that maybe are beyond me, I'll tell you in a heartbeat. You need someone who does credit all day, every day. And she said some really good things that I talk about is like risk-based lending. That's what this is. That's the first thing she said. It kind of made me smile because I say it in all my seminars, and I never heard a credit person mention it. This is risk-based lending.
Mm-hmm.
You know, you're getting a home at $200,000, $300,000, $400,000, and you're putting down a minimum amount. So please embrace the process. Don't get mad at me. Don't get mad at Shawanda. Don't get mad at Corinne about the documents we need. We're definitely not picking on you. We ask the same documents.
We pick on everybody.
Do we have to say we pick on everybody? we ask for the same things from everybody.
That's why I'm saying we pick on everybody.
Yeah, we equally are bullies, huh?
It's not just you, it's just the process, and it's what has to happen. There's no getting around it. There's, I don't want to have to, get these things from you, but it's what's necessary when you are, when you are getting hundreds of thousands of dollars from someone, like they get all into everything, and it's just
in your business.
In your business, because they want to make sure that they think you're going to pay them back. They want to do everything for you to think to know that you're going to pay them back.
I was just laughing because I was thinking about, even $500 you borrow from certain family members. They're like, "What you doing? Where you going? Did you do this yet? You using this for your nails?
You sign this and prick your finger and sign the blood. Put your blood here.
$500. Yeah. Let alone 500,000.
And folks get a little agitated. Yeah. You're borrowing $350,000. What wouldn't you ask me for? That's what I tell folks. What things would you not ask me for if you were borrowing $350,000 from me? So, exactly. And just like Corinne said, don't buy nothing. And when you're in the process with me and Shawanda, we'll tell you, don't let Bob's pull your credit because you're thinking about the mattress you want to buy because you may sleep on it, but you won't sleep in it. You'll sleep on that mattress, but you ain't gonna sleep in that house if you get that.
Like no new
go get it from. You can leave from settlement and go do what you want, but don't do it on the way to settlement.
Not on the way to settlement. I was like, because I have people who are now, they need a new car. They need, can we get through to closing? As soon as we're done, please, go right to the car dealer. After that,
straight there.
Go straight to the car dealer. Once everything is signed and done, have that. Get your furniture. If you want new windows, whatever it is you want. Just after we get to the closing table, hold on and just stuff it out a little bit until we get to the closing table. So that's a common thing, and it's like, please don't do that. Please don't buy a car.
Common.
Especially a car. Like a car is like one of the highest things you can buy.
Didn't we just have this conversation about one of our clients?
Yeah, like the car is the highest thing you could buy.
Don't buy it.
And that, and people don't, going through the process, you don't know what you should be and should not be doing. So I'm glad that our clients are like asking or talking to us about some of the things that they're doing prior to doing it, because once it's done, it's hard to undo. I have been in a transaction where someone has acquired new things, and it delayed. We still made it to the table, but it delayed everything, like reversing some of the things. We had to end up refinancing, a whole bunch of different things had to happen, like giving stuff back, paying stuff off. So I mean, it took a little bit longer, but we got there. But sometimes you can't reverse it, and it may be too late because the seller may say, "Look, I'm out of here. I'm about to find a buyer that can go."
It's ready now. Yeah.
Right. So, so that is one of the things. And so, what are you experiencing as far as are people refi? Are you getting a lot of refis with people during COVID?
I'm getting a lot of refi requests. Some of them were able to do, some of them were not because of the forbearance. I've gotten a few folks who wanted to be pre-approved for new homes. Perfect credit, 750 scores, but they have an existing home, and the first thing I see is forbearance, and then the quasi argument starts, and I'm like, well, you arguing with the wrong person.
Right.
I'm not Mr. Wells from Wells Fargo or whoever you have your current mortgage with. And I understand that they said it's not going on your credit report, but I usually cut and paste and just send it to them, so you don't think I'm making it up.
And so how long will that, when they do a forbearance, is there a certain time frame that it
Well,
will remain, or?
I believe Fannie and Freddie are just starting to come out with guidelines on that. So
'Cause this is all new.
yeah, it's kind of and I can tell you maybe what I understand, but I would say we're still waiting for them to say specifically. What I think may happen is that, you know, once you come out of the forbearance, you may have to do a certain amount of one-time payments, and then you're eligible. You know, you have to catch up, because keep in mind, and this is huge when you guys are agreeing to the forbearance, some of them may put your payments to the end, but most of them are not. Most of them are like 3 months from now. If your payment is $3,000, we want $9,000 in 3 months.
Plus,
so it's not really helping you. So you may have to catch up, and then you might have to make 2-3 payments going forward, and then you're able to refinance, you're able to get pre-approved, you're able to buy your new home. So you know, they're really just starting to put out guidelines on that. But you know, you really want to know what you're agreeing to, because if you're just pushing the payment back 3 months, is that helping you? Maybe it is.
Maybe.
Or maybe you're pushing a half a payment back, you know, or something, because you're, instead of making your 3,000, you're able to make 1,500 for whatever reason. But just keep in mind, you may owe them in 3 months or 6 months. You may owe them a lump sum of money.
So is the mindset behind that about not doing it, that you know, basically you just ask someone, could you not pay for a hardship, but then you want to refinance and say that you're going to pay, and it doesn't match, doesn't go together? Is that kind of the logic in it?
Probably so. I mean, that sounds about right. I mean, you know, you're telling me you can't pay, but now you want to refinance for a lower payment. And I think it's part of the reason why when this first came out, the market kind of went upside down as far as lending. Guidelines changed and people were scrambling, because, you know, people could effectively have purchased a home, closed on Monday, and then applied for forbearance on Tuesday. So, you know, the servicer still has to pay taxes and insurance, so they're still paying. You may not be paying, but the servicer is paying. So that's why you saw a lot of the initial guideline changes, and it's starting to settle down some. But you know, you're still feeling it. We're all still feeling some of the effects of it.
Yeah, definitely. Definitely that. And what was another question? And as far as credit scores, now, during COVID, I know there have been some differences in, you know, lower scores, and now things have risen for some of the places. So what is the minimum for your company now?
We're at about a 640.
Okay.
Right, as we speak. There's some companies probably doing a little lower, some companies doing a little bit higher, or a lot higher is relative.
Higher.
You know, I don't like to speak for other companies. But you know, I think we're like shocked. I think a lot of people in the lending world were shocked at first, because no one knew how to act. I mean, and even us, I would like to say us grassroots folks, we're on the front line. We're trying to find clients, get them pre-approved, you know, and you seem like you were changing the rules on us every day. You know, we were like, oh no. And people we had pre-approved in the past, or maybe under contract with like new construction folks who may have gone under contract 6 months ago, who, you know, were fine or on the road to be fine for June, all of a sudden found out they couldn't buy their houses.
Right.
You know, scores weren't there. So
Yeah. I've seen a lot of people looking at different houses. I've seen a lot of people say, "Oh, but fell through, buyer lost employment,
Mm-hmm.
um, this type of
There's
thing."
several of those.
I've seen that a lot um, in
Yeah.
this market. And another question is like, what could be like the biggest difference? I know the higher the credit score, the better.
Mm-hmm.
But say, okay, if I'm a 640 and someone else is a 640 or 720, is there like a guideline that makes, because I know the better your credit, usually the more house, the better it is, your
Yeah.
payments, your interest rate and things like that. How is it like work as far as if I'm a 640 and then I jump to a 700, does that help me? How much does that help
Um,
me or not?
yeah, I mean, it could help you tremendously with interest rates. I mean, you may go from in a good market, you may have to use an FHA loan, and you may go heavy option of using conventional or FHA. So that maybe that allows you to put down 3% instead of 3.5%, which doesn't sound like a lot, but it could be. It could be huge in
Mm-hmm.
terms of your transaction. Let's say you're using like the Maryland mortgage program, which we use a lot here. Maryland at 640 will only allow your DTI, debt to income, to be at about a 42%
Oops,
debt to
sorry.
income. Does
Sorry.
that mean?
That was me.
Okay. Hang on one second. Can you guys still hear me?
Yes, I can still
Um,
hear you. There you go. Sorry
okay,
about
so it's like she cut me off. So, suppose you can only go to 42% debt to income, and then Maryland wants you to have reserves at a 640 to a 659. You go to a 660, they'll allow your debt to income to be 45% with no reserves. If you go to a 680 and above, they'll allow your debt to income to be 50%. So for the program, maybe it's not really changing the rate much, but it's changing the amount of money that you can borrow. It's, and we have clients like that where because their scores are here, they're in this box. But
Right.
we can move them here, the box broadens. If we can move them here, the box broadens even more. So credit score is huge. And, I have a client who today he's in the 700s. So he possibly wanted to use the program. Obviously, the benefit, it gives him money, but if you use the program, you use the program's rates. But he also has a very good score, so he had the option of, maybe he didn't want to use the program, and where and what he wanted to buy, the type of loan he was using, it was a swing from maybe 3 3/4 using the program to, if he didn't use the program, to a 2.5% interest rate.
Right.
So it's huge for him as far as payment. That was a $200 and some swing in payment. Do you want the money from the program, or he had the money? So I was like, well, you got some soul searching to do.
Right.
You
Decisions, but it's good to have that option, like the option to be able to use the program or not use the program instead of being set, I don't even have the option to use the program.
Absolutely.
So
Absolutely.
that's
Options are good. Options are
again
good.
the leverage of having the higher credit score still showing the leverage that you can get just by having the option of using a program or not, because if you're not high enough, you can't use a program.
Exactly. And he was able to, he and I even talked about a swing in the middle where maybe he didn't use the program, but we gave him a higher interest rate, which was still better than a program, but we gave him a couple $1,000s in credit because, he has that. So he has like such an option because his score was so good. It just really helped him. And he still has more options that we didn't even really touch, because it depends on where he purchases, what purchase price, that we may be able to do other things for him internally.
Okay.
That is such a good feeling. Oh gosh.
Options, yeah.
Yeah, that's what I'm experiencing right now, refinancing. And I was sharing with some clients. I love that we're talking about the swing and the this and the that and how much and which program. We're not talking about yes or no. We're just talking about how you want to do this, Corinne. Yeah, man, exactly. I feel like a baller. We've been just having a very abundant conversation. I love it. I haven't closed yet, but I'm just excited because we're just talking about
Yeah.
Absolutely.
What we do,
Funny
not
thing is,
if we can do it or not.
Look, Corinne, I've had a credit card since I'm 51. I've had a credit card. This one of the cards I've had. I got one. I'm dating myself. I joined the police department in 1990, and the first thing I did was get a credit card, and I've had the same credit card since 1990.
Wow.
So, yeah.
Well, who told you to keep it though? I went to college in 1990.
Talk to me about credit when I was young.
Yeah, nobody did that. I got a card from Hampton University, $250 Visa, and I didn't know what to do with that. I probably maxed it out in the first week. In 1990, I was a freshman at Hampton.
Oh yeah.
Wow.
Yeah, I just was smart with it. My father taught me. So even I think because of what I wanted to do at the time for a living, I had to have good credit because that's one of the things they did was check your credit. So
Right.
so I worked on it.
Yeah, I definitely want to normalize the credit conversations with family and children, because again, as a real estate agent, I know that real estate is one of the quickest ways to gain wealth. And you can't do that if you have bad credit. But if you start your kids out early, even if they get a condo, when they go to school, if they go to college and they purchase the condo that they're in and they rent to, people, that is starting out. And that's something that they could continue to do. They could continue to do and continue to rent out. If they go to this college town, people are always going to want to rent it out. So if they just get a condo when they go off to college, instead of maybe staying on the dorm or whatever the case may be, and renting it out, think about how different their life will be when they get out of school. They already have an investment. And then they could just go on from there. They're building credit because a mortgage is being paid, and they get out of school and maybe they want to get a house wherever else they are. But and then buying, and living in a primary residence, you pay less opposed to an investor loans. Buy a house, stay in it for a while, and then moving on is what a lot of people do. And it's different for everyone. Some people want a forever place and that kind of thing. However, some people are going and they're purchasing a primary residence, staying in it for a while, and then moving to the next place. That is fine. That is, that's perfectly fine to do. But you're starting to build a legacy and wealth for yourself and your family, and able to do some of your goals. And I definitely wish that I knew way more than I know now. However, it's important to me to talk to people about it so that they understand, because it's all in, you don't know what you don't know. And when you know, you should attempt to share it with someone.
Absolutely.
So that's why I'm wanting to do different things like this, to have the dialogue. So, because some people don't know where to start, because maybe their parents didn't know how to handle the money, handle the credit, or they didn't listen, whatever the case may be. Knowing now is the issue, is the thing. So I appreciate you guys taking your time and giving us some more insight into this. I've put everyone's contact information into the to the chat, into the Facebook and everything. And then of course, if anyone needs to reach me, you know how to reach me as well. Facebook, Instagram, all of that. But I'll also put my information. But I definitely appreciate you guys taking the time out of your day and talking about this very important thing that we are all we all have to everybody needs to know about their credit, and how to fix it, and where to start. And it's okay to not know. So I appreciate it. Do you guys have any? I don't think we have any questions. Do we have any questions? Let's see. Trying to look in a few places here. Okay, we don't, which is normal. Most people they'll contact you guys offline. They'll contact you guys offline, but I definitely want to again thank you both for the time and thank everyone for tuning in. And we'll have something again soon. And again, please reach out. Don't suffer in silence.
Thank you for the invite.
Thank you.
It's always fun.
Always, and thank you again, Corinne, and thank you, Paul.
Nice meeting you, Paul.
Thank you, Corinne. I'm gonna get your number, your contact from Shawanda, because I probably
Perfect.
Same to you.
All right. Well, we will adjourn, and thank you again, and we'll talk soon.
All right. Take care. Have a good evening. Thank you.
Have a good evening, everyone. Bye-bye.